Tariffs are hitting the news again. Prior to Trump's Liberation Day, the US average effective tariff rate was around 2.4%. In this video, we're going to look at how that number has changed during Trump's administration, what it is now, and how that might affect your investments. Let me take you through the past 13 months, because we get bombarded with so many tariff figures, it's kind of hard to keep track of what has actually been happening. This is a simplified graphic of the timeline, but it helps us understand the average US tariff rates over different periods. January 2025, that's sort of the starting point, before any sweeping changes and back when US tariffs were kind of super low. At this point, they sat at an average of around 2.4%. Of course, that might differ for certain products, industries, countries, but the US tariff system as a whole had an effective rate of around 2.4%, an extremely low tariff situation, which kind of exemplifies the US's modern history of having a relatively free trade approach to global markets. Then, in April 2025, Trump invokes a 1977 law called the International Emergency Economic Powers Act. It's used to justify tariffs on virtually every country, and it was called Liberation Day. By April the 9th, the average effective US tariff rate hit somewhere between 27 and 28%, a very high level, and the markets hated it. The S&P dropped around 19% as a result, but then, as time goes on, these high tariff rates are used as part of a negotiating leverage strategy, and the US goes on a trade agreement blitz. The UK, EU, Vietnam, South Korea, Japan, even China. By the end of 2025, that effective rate has come down to around about 16.8%. Still extremely high compared to historical figures, especially for the US, but well below the peak figures that were announced in April. And then last week, the US Supreme Court ruled that the International Emergency Economic Powers Act doesn't actually authorize the president to impose tariffs to the sweeping levels that he did. The bulk of the tariff regime is stripped out in a single decision. For a very brief window, the average effective rate dropped down towards around about 9%, which would have represented a gigantic decrease. Then, almost immediately, Trump signs a replacement scheme the same day. A 15% global tariff under Section 122 of the Trade Act of 1974. Early indications show that would bring the effective US tariff rate back up to around 15.4%, because there are still some high tariffs imposed which didn't get impacted by the Supreme Court decision. That's why it's a touch higher than just the baseline 15%. But it means, from a macro standpoint, the US is actually in a kind of similar position to where it was before, 15.4% now versus around 16% before. Very little has immediately changed. However, the new Section 221 powers have a 150-day time limit. It expires on July the 24th unless Congress votes to extend it. That is a fundamentally different situation to an open-ended emergency powers tariff, and it brings more uncertainty. So the bottom line on the macro picture is 2.4%, up to around 27%, and now we're back down to around 15.4%. Real quick, if you're not signed up to my free stock screener, then you need to check it out, because since I started sharing these with you at the start of last year, they've significantly outperformed the S&P 500. My lower and balanced risk strategies in particular filter stocks by a bunch of metrics which over time have continually found great businesses at fair to low valuations. This is freely available. You can see the stocks which match from the USA's top 500, totally free. I'll put a link down there. 14,000 people use it already, so come and join us. But back to tariffs. The rate any individual country faces actually depends on their situation before the ruling to some extent. There are some winners and some losers. Let me run through the ones that matter most for stock investors. First off, China. They still have the highest rates by far, but they have decreased. At its peak, its effective rate hit about 47%, but that had recently declined to around about 39%. After the ruling, however, and because there are some tariffs inflicted on China which are not related to the Supreme Court decision, their average rate comes down to around about 35%. Brazil, Canada, and Mexico are some of the big winners here, seeing significant decreases in their tariff rates. The EU's tariff rate has basically stayed the same. They negotiated a 15% deal last year, so the new rate is also 15%. There's a different legal basis now, but it's essentially the same number. Us in the UK, well, it looks like we're going to have a worse rate. We negotiated a 10% rate last year, but as far as I can tell, these new rules override any existing agreements, which should see the UK's rate increase to 15% despite the agreement that was signed last year. So overall, there are winners and losers, but generally, tariff rates have remained similar or decreased. And the decreases expected by China are pretty crucial since they're such a huge manufacturer. How that impacts individual stocks, though, is quite complex because these are country-specific changes, and whether it impacts your stocks is very heavily weighted by whether they have any relationships with a country which now has higher or lower tariffs. But there are some big trends which we can understand quite well, and one huge event coming up which you need to watch out for. Consumer electronics should be one of the big winners here. Apple is one of the most obvious examples. Most iPhones are still made in China, and the replacement 15% global tariff meaningfully lowers the rate of those Chinese goods. It should represent a genuine cost reduction, which is no doubt why we've seen a modest rise in Apple's prices since this announcement, even though many stocks have been declining. But generally speaking, if your stocks manufacture their products in China, the likelihood is they've just experienced a tariff decrease. For AI chips, GPU designers, the ruling is basically irrelevant because there's a nuance here relative to these semiconductor stocks. 5 weeks before the Supreme Court ruling, Trump signed a 25% tariff on advanced AI semiconductors. It was nothing to do with the International Emergency Economic Powers Act, and so the court rulings didn't touch it. The tariff specifically targets chips being exported to China. Chips imported for use in US data centers are exempt, so if you're holding Nvidia because of the Amazon, Google, Meta, Microsoft data center buildouts, that thesis is completely untouched. From what I can see, this week's ruling really changes nothing for these stocks. For AI-related equipment stocks, however, the picture is a little bit different and quite frankly, more unknown. For those equipment suppliers like ASML, Lam Research, Applied Materials, April the 14th, not very far away, is the date to watch. That's when the government is due to report back to Trump on semiconductor trade, and tariffs on equipment are explicitly on the table. ASML already withdrew its 2026 guidance last year because of this uncertainty. Their machines cost between 200 and 400 million euros each. So a 25% tariff, which would equal the tariffs on the GPUs sent to China, would likely have a big impact. And that kind of marries with what I actually think the biggest impact of the last week is. It's not really the tariff swings themselves in a way, but the drastic uncertainty which businesses face as a result. Because right now, we just don't know what will happen next week. Never mind next month or next year. The latest 15% tariffs enacted only have a 150-day lifespan. So the only thing we do know for sure is that things will change. Things will remain uncertain in the short term at least, and both businesses and the market hate uncertainty. But for us as investors, there's likely to be opportunities found within that uncertainty because it will most likely lead to periods of overly negative sentiment or unjust share price drops. It's another reason to keep a close eye on the stocks you like because the more worried the market gets, the better valuations usually become. Here's an example. This, by the way, is the Super Investor platform on my website. It lets you create custom strategies, or you can just use our templates to help you find some really great stocks. We have a bespoke scoring system for each stock, and high-scoring stocks have been significantly beating the S&P on average since we've launched. And it has absolutely loads of research features, like comparisons to industry competitors, and two really cool features we've just released, where it'll analyze the latest earnings call for you, giving you all the information that you need to know, and it has the industry outlook for each stock. Basically, everything you need to help you find better investments is here. The currently discounted price will be going up soon. I'll share more details on that probably next week. But check this out. Microsoft. I talked about them last week, and now they're trading at just $385. That represents a price to earnings ratio of just 25, and day by day, the valuation continues to get better. I did a full video on when the huge capex spending by companies like Microsoft is likely to start bringing a return. So if you haven't seen that, you can watch it here because this is looking like an amazing opportunity.